Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Axel Merk, and we cover a lot. So the macro outlook is a fun one to cover. Equity markets, US dollar, monetary and fiscal policies, precious metals. There's a lot to unpack, and Axel actually has some pretty unique views on a lot of them. Where does this all end? Fiscal austerity or debt jubilee? Not likely. Inflation? Obviously, but less obvious is when. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review on Apple. If you're watching this on YouTube, please subscribe to the channel and or give the video a thumbs up. All of these things really help, and I really appreciate it. Really enjoyed this conversation with Axel. Apparently I say really a lot, but this one is really packed full of little tidbits, and I hope that you enjoy. Awesome. Axel, welcome to the show. Happy to have you.
Great to be with you.
Thanks for taking the time today. Really appreciate it. So I wanted to start off today. There's a lot going on. And actually, we started off the conversation talking about how hard it is to know what's going on because everything just seems new and wild. So before we get into all of that, I want to start off with a little bit about you, who you are and where you are.
Who am I? Well, I'm just a humble investor. Do a little bit more than that. We manage about a billion these days in mostly precious metals related assets, gold and gold miners. We're really active in all asset classes. I'm well known for my views on currencies. I started business in the 90s, but we really got to the public front in the early 2000s when we started being concerned about the twin deficits, when we started doing deep dives into central banks. We warned about the financial crisis. I don't consider myself following the herds. Anybody who ever gives me a label, I kind of just grin, but I don't like that because I do my own thing, and I disagree with even today with many of the doomsday sayers of what's happening. Right. So I always have some nuances. I see my role in when I talk to you and others in giving people food for thought. And to kind of tie into what we talked about before we went on air, being humble, I think, is important because none of us really have a clue. And when I look at investing, it's not so much about what will happen tomorrow. It's about a risk assessment, right? What are the odds of something happening? And do you think it's necessary or worthwhile to take that into account? And so that might sound a little dull, but I've been around the block a few times, and so I've learned to, you can call it cynical or humble or whatever it may be.
Oh, I mean, I think that's highly relevant, and thinking that you can consistently always call the correct direction, it's just not really feasible at all.
No,
Uh,
it's more about the risks you're going to take, right? I mean, let me give you the example of 2008. A lot of folks came out late 2008, early 2009. Oh, this is the time to double down. You got to invest now. And if you look at the history, that was correct. At the same time, I think it was irresponsible for many to do that, because the only time you can double down is if it's compatible with your risk profile. So if you did the quote unquote right thing and rebalanced, took chips off the table as times were good, sure, you have cash, by all means, double down. But most people didn't do that, right? Most people just went in there, had asset prices went up. That means they had more money allocated to the equity markets than they should have. Asset prices plunged dramatically. So now you lost half of your net worth and you should double down. That's just not right. And so it's in this context, investing is a very, very personal thing. And one thing I tell them, if people ask me, where do you invest? Where do you invest? And the one advice I can give is invest in yourself, right? You are like a fixed income security. You are in control of that. And so try to retain your earnings power, be healthy. That's the sort of thing you can control rather than buying X, Y, or Z. So anyway.
oh, absolutely. And those have the highest ROI and impact your happiness and all these other
Absolutely.
things that are way more important than, numbers on a screen going up. That's for sure. So it's a good segue talking about crazy high asset prices and valuations at all times highs, perhaps. Let's start off. I mean, on your website, you talk a lot about uh, uh, economic cycles, business cycles, stock markets. Let's start off kind of with a bird's eye view of what's happening in financial markets right now.
Exactly. And I said I might disagree with some. So asset prices may be high. That doesn't mean they can't go higher, right? Valuation metrics are very, very difficult indicator as to where things are going to be. Greenspan in late 96 warned about irrational exuberance. And so depending on the type of investor you are, is, oh my God, something is too expensive, I stay on the sidelines. Or I say, hey, I'm going to peak. I'm going to time the peak here. I'm going to sell in March 2000. Um, we are, and one of the, you mentioned business cycle. We publish business cycle report, equity market report, and the reason we publish the business cycle report is not because we want to forecast GDP to the second decimal point. No, it's because that historically speaking, it's the bear markets that have happened during economic expansions are much less severe than those during recessions. The real 40%, 50% plus bear markets we have seen in the equity markets have come during economic recessions. And at least in my view, and I would think many in your audience will agree, we're probably in the early stages of a recovery. Now, you can ask how sustainable is it? What issues are there? But because we are in the early stages of a recovery, and because we have kind of a global coordinated effort by both fiscal and monetary um, authorities to reflate the world, that to me creates its own set of dynamics, which kind of inflates a lot of stuff. Now, is it going to have a good ending? Well, that's a very different story, right? I say we're in the early 20s, and with that, I mean the early 1920s. And there were obviously, even in the equity market, some severe downturns in that before 1929, but 1929 didn't end so well. And then the 1930s didn't end so well either. So I'm very concerned. But as we speak right now, I think the global reflationary trend is firmly intact, and so I'm actually, even though valuations are high, I'm not concerned about the S&P right now.
The roaring 20s, the repeat, and it's highly relevant. So when you talk about this reflation globally because of monetary and fiscal policies coordinated globally, can you dive into that in a little bit more detail, what you mean there?
Oh, how many hours do you want to spend on that?
Yeah.
So let me, one of the things I try to do in interviews like these, I try to get people thinking about things they don't think about every day. And so let me just dive in some corners, and you correct me if I go off too much on a tangent. But global reflation means, the short of it is, people will feel more confident that they'll borrow. That happens on the small scale. Big business has access to cash flow. Small business has to worry about cash flow. When a vaccine becomes available, you'll start investing. You see business investment pick up. On a global scale, it means people will borrow money. Now, you can borrow in local currency, but predominantly people borrow in US dollar. And what that means is that when somebody in emerging markets borrows money in the US dollar, it's akin to a short sale. They're selling the dollar to buy the higher yielding currency. And so as long as that reflation takes place, there's a downward pressure on the US dollar, there's an upward pressure on emerging markets. It's part of the reason why I think we've entered after several years of a bull market in the dollar, we've entered a secular bear market in the dollar last March. And so that trend should benefit emerging markets, that should weaken the US dollar. Now, clearly, if we have a severe risk off period, you have a quote unquote short squeeze. Doesn't need to be as severe as we saw in recent volatile stocks. But that's one of the reasons you have this quote unquote flight to quality. I doubt that there's so much quality necessarily about the US dollar, but you have that thing going to reverse, because when there's a shock, people de-risk, they take down leverage, and when they take down leverage on a global scale, they have to buy back the dollar. And so currently, one of the themes in the reflationary trend is that. The other thing, to just hit another point, in recent years, the S&P 500 has really been the place to be for many global asset managers, and not just on paper. Institutions over allocated to the US, and they are over allocated to S&P, and obviously within that to some darlings, and that's where kind of the high valuations come in. As globally we're trying to reflate, people will diversify, and not just individual, but institutional managers as well. That should benefit small cap, value-based stocks. That should benefit emerging markets. And by the way, if you go back to 2000, we had an asset bubble burst. But the Russell 2000 actually did very well in that period, while the NASDAQ plunged. Kind of the broad-based small cap stuff actually appreciated in value over that same period. And so there's always a bull market somewhere. I happen to believe that, I mean, obviously, a lot of the gains in the markets may have been taken up front with that amazing confidence the equity markets have had, but that doesn't mean the money won't lush around somewhere. And I think a lot of the places it's going to go to is more to kind of to those sort of areas. And by the way, just to kind of digress a tad more, emerging markets are not what they used to be. Much heavier emphasis on China, much heavier emphasis on characteristics more associated with a developed economy. Emerging markets used to be banks and energy companies, and now it's high tech companies. So if when you do historic comparisons, a lot of the underlying fabric has changed.
Yeah, so that makes a lot of sense. So downward pressure on the US dollar, small cap, well, these gains from the S&P 500, big tech that are kind of over allocated and have risen a lot will be redistributed to small cap value emerging markets. When you say emerging markets, that is an interesting concept or comment. I mean, traditionally it was like significantly China or India. Are you picking specific emerging markets, say Brazil, or how do you think through that?
Actually, China didn't used to be one of the big ones. I happen to, but that's just me. Again, I don't want to go too much into specific advice. China, I like. I know that there are many things happening in China that we don't like, but as far as kind of the ability to reflate, China it has really many levels. Now, clearly, there are some issues in China and potential bubbles, but if you look at just the potential there in the markets, there's really an opportunity for breaking out. And another market I like to point out that's a little bit more on a fundamental basis is South Korea. And the reason I mentioned South Korea is that the South Korean exchange is very highly correlated to international trade. So when international trade picks up, that's a leading indicator how the market will react. And so if you think that global trade is going to pick up again, South Korea may be a place to be. Now, again, this is an investment advice, and I happen to be investing in those markets, so I may be touting my own horn. You mentioned Brazil. I know too little about Brazil, right? But it's part of the same theme. But I try to stick to the things where I have a better grasp of things.
Yeah, that makes sense. I mean, you mentioned that this is kind of the roaring 20s all over again. So there's room to run, but kind of alluded to the fact that the roaring 20s didn't end well. And this one potentially, I mean, it can keep going up for a lot longer than we ever think, right? But this time feels a lot different with global debts as high as they are around the world. I mean, I always say the world is drunk on cheap debt, right? And it will continue to play that cycle until it doesn't play. So how do you think through transitioning from this kind of risk on roaring 20s valuations are just a number to, oh my gosh, well, you mentioned that you don't really agree with like the doomsday scenario. Not necessarily that I do, but a lot of these scenarios kind of end with pitchforks and torches, right?
Sure. Well, I mean, let me clarify a few things. So first of all, I do subscribe to doomsday scenario in the sense that this is not going to end well. I just don't happen to think that that day of reckoning is happening tomorrow. I've seen policymakers kick the can down the road so many times that I think that will continue to happen. Now, if I listen to myself here, I say, oh my God, I'm this equity bull here, right? I actually think that the time to invest in equities may be because it's reflationary, but again, it goes back to can you afford to, right? And can you afford to build a financial cushion now in the roaring 20s so that when the reckoning comes, you're prepared? Now, obviously, with the caveat and risk that I might be wrong, and that day of reckoning is going to come much earlier. And so you talk about pivoting. I'm not pivoting. I am just as I'm investing in equities, I am just as much investing in other things to try to prepare me. And one of the things that when the advantage that the rich person has is that they can have multiple revenue streams. So when something doesn't go well, that you can you can go around, right? I mean, I mentioned early on, investing in yourself, right? Investing in the equity markets. Well, you can invest in real estate, get rental income, and you can invest in precious metals. I mentioned the outset, we are best known for our work on the precious metals side. So I substantially invest in that space because I happen to believe that we are an environment where well, let me just back up here. Gold, if you just take that, right? There are three types of gold investors, very crudely said. One is the investor who believes that, oh, gold is not correlated to any other asset really much, and so it's good as a diversifier. And those types of investors have been increasing. Then there is the speculator. They just go on for a ride, and currently they might be playing something that's more volatile. There's some competition there. But then there's a substantial investor that says, hey, gold is a brick, doesn't pay me any dividend, but if you don't get compensated for holding cash, gold may be doing fine. And if there's one correlation the price of gold has, it's to 10-year yields. If you and notably real yields. So if you deduct inflation from the 10-year return, there's a reasonably high correlation. And without getting too technical, if the Federal Reserve commits to keeping rates low, but the economy is going to pick up, net of inflation, real rates are going to continue to decline. And so I happen to think that, yes, gold should do very, very well in this sort of environment. And so to the extent I can afford to, I invest in both of those to try to have a diversifier. Now, in recent months, there has been a higher correlation between gold and the S&P 500. And some people say, hey, you don't need one or the other. Those correlations will break down. And then also, in the last cycle we had in precious metals, gold miners didn't do so well because the reason to invest in gold miners is because you kind of get that leverage. At least in theory, the cost of mining is fixed, but then as the price of gold goes up, you have a disproportionate benefit. Didn't quite work that way because a huge portion of gold mining is energy costs. Oil prices were hugely high. Then the governments wanted to have more taxes. They work higher wages. This time around, there is much more discipline in the mining industry. Also, acquisitions aren't happening as rapidly. Now, obviously, that's a very speculative area. And before I give it back to you, one thing that I see as somebody who's providing, who's active in the markets and providing some investment products and services, investors want to have their cake and eat it. And what I mean with that is, if people were petrified about where we are, they would hold cash and some gold. Whereas instead, what we see is people have equities and gold miners, and gold miners even better in quotes. I'm not suggesting that it's better. It's obviously very speculative, but because gold miners are so volatile, you don't need much in your portfolio to get diversification. And so that's the sort of environment we're in. Whether that's the right place to be or not is, of course, another question. But I'm just pushing back to you and saying, hey, yeah, I like equities, and I don't think everything is dandy. No, I think this is the time to prepare for what's down the road.
Yeah, no, and thanks for that. And I've listened to your stuff. I know you're not just a full perma equity bull, but
it's not at all.
It's nice to always start with equities because at least in America, the kind of consistent over allocation and emphasis on equities, and that lends itself. I mean, especially right now, one of my reasons for being bullish on gold, in addition to all the things we've talked about, is the under allocation of gold across many, many portfolios. I mean, it's just very much under owned. It took me a long time to kind of get across the hurdle doing CFA and understanding, discounted cash flows. It was hard to invest in something as a store of value, knowing it wouldn't kick off a dividend or anything like that. So, yeah, I totally get it. In terms of other ways of playing the gold play, you mentioned miners. Do you have any thoughts on silver or other precious metals?
Well, part of the reason why we focus on gold and talk about gold a lot is because the dynamics are much simpler. Like gold is just a brick. There's jewelry use, obviously, but the industrial use is comparatively low. The moment you go to other metals, it gets far more complicated, right? Because in an economic downturn, often silver gets drawn down and then it spikes up. Now, clearly, because of the greater volatility, some people love it, but it really, I mean, it ultimately depends on the risk profile that some people want to have. And we had this quote unquote attempt of a silver squeeze the other day. Well, we do deep dives into the markets, and the reason why this quote unquote squeeze didn't last too long is because there wasn't much to be squeezed. The positioning in the market was not at extremes. We monitor the CFTC data; those are the data in the derivatives markets very closely. And so there wasn't anything extreme to be squeezed. The other thing, of course, compared to some of these heavily shorted securities, the silver market is much broader, and so that means if you have a rallying cry to action in the blogosphere, sure, it may empty the inventory in some coin dealers, but it's going to make much less of a dent in the markets. And if anything, of course, if you had a bunch of people, let's say you wanted to buy 10 silver coins this year, and because of that call to action, you bought 5 silver coins to quote unquote squeeze the market. Well, are you going to buy more than 10 coins that year, or will you have bought some things more and now you're just introducing some additional volatility? Now, on the flip side of it, the sort of talk we had does increase potentially the audience that learns about precious metals, and so there might be some new ones coming in. And if I can just digress here for a second, I mentioned inflation and real interest rates being a driver for this. The major driver for inflation, in my view, is inflation expectations. And now that may sound arcane, but if you go back to the 1970s, it's because you think prices will be unstable, because you will be higher, that you will try as hard as you can to push prices higher if your worker demand higher wages. And so in that context, now, and as this is airing, we don't know whether the 1.9 trillion stimulus will have passed, but my guess is much of it will be. We will be overstimulating the economy. And I had just the other day a chat with somebody who is not political, not into monetary policy or anything. He asked me whether this will be inflationary. And Larry Summers, of all people, said it may well be. And so this sort of thing can become a self-fulfilling prophecy in people getting concerned that this will be inflationary, and as a result, change their consumer behavior. And to just kind of put a nail in the coffin of thinking that I'm kind of a permanent bull here. The thing I'm concerned about, I'm actually not concerned about the inflationary bout we're going to see in the very near term because of the year-over-year comparisons. What I am petrified about is this thing that we're not thinking about inflation, that the Federal Reserve will allow intentionally inflation to run high in the context of an over-stimulus, right, of a global reflationary move. And Larry Summers, a person I rarely agree with, right, points to this. And Janet Yellen, now Treasury Secretary, pushes back and saying, oh, the Federal Reserve knows how to deal with inflation. So who cares? Well, we're going to have so much leverage in the system that this is going to create a lot of instability. And so going kind of back to the investment thesis, and why it's so important that you only do what you can afford to do. The same with precious metals, right? Precious metals are volatile. It's because what I see, I don't see that kind of we have a bubble in the crash. No, I see a tremendous amount of instability going forward, where just think about the years in the Eurozone where policymakers and overnights kind of changed the rules of the game, right? Policymakers will kick the can down the road somehow, and you don't know what's going to whack you. And so that's the sort of thing, you got to be resilient to that. And there is no easy answer to that. And I just happen to think that in the short term, equity prices will benefit, but I don't know. I don't think this is going to end well.
Yeah, and it can't eventually on a long enough time horizon, but that time horizon can be a lot longer than all of us kind of imagine. I mean, all of these, so this coming stimulus, all of these things contribute to the downward pressure on the dollar as well as the global re-leveraging. But my issue is that it's such a coordinated monetary policy, fiscal policy globally, that it's you may be bearish on the dollar, but it's hard to be bullish on the euro or the yen or any other currency. So in this case, do you start to view gold as more of an alternative currency as opposed to a investment?
Well, that's my shop. I have always looked at gold as the ultimate hard currency. And for many years, actually, the euro was very highly correlated to gold. And when I mentioned this to folks in the gold space, of course, I got a very stern look. That that correlation has started to break down, and in part because we now got Madame Lagarde at the European Central Bank, who is everything but a hawk, and obviously her predecessor wasn't either. What I see happening is yes, so gold to and um, I mean, ultimately, the question is: does it matter how one or I look at gold versus currencies? The race has been towards zero on interest rates throughout the world. As we reflate, it appears that New Zealand and Australia may take the lead of kind of stepping away from that a little bit. I'm not suggesting they're going to raise rates much, but because their economies have been more shielded from COVID, they are historically more dynamic economies. I think there will be some things happening. We will have more activism by central banks probably, and that activism, though, right now isn't so much on the value of the currency. It is more trying to support the fiscal authorities. And that's a very dangerous trend. Not so much, I mean, people, I'm sure some of your guests have talked about MMT. Central banks, when they started buying mortgage-backed securities, they stepped away from conducting mortgage monetary policy. Monetary policy is really worrying about the price level, money supply, things like that. The moment you allocate money to a specific sector of the economy, you're conducting fiscal policy. And the problem with that is that you lose your independence. And the problem with that is you're becoming intertwined. And you see that in the US happening right now. The Federal Reserve is financing the spending. Well, who cares how much money you're spending, right? And so you're getting the taste that, oh, we're spending 1.9 trillion in addition. Who cares, right? The money just grows on trees. And that creates also a feedback loop. You see it in the European Central Bank, where Madame Lagarde, the former French Prime Minister and the head of the IMF, talks about climate change. When I first thought that, oh, central banks are going to worry about climate change, it says, okay, well, sure, if we have a major disaster, you got to make sure the banks stay afloat. That's not what she's talking about. She is talking about making it easier for green companies to have access to credit from a central bank point of view. And so you're diving deeply into fiscal things, unelected officials. And that is, of course, and then politicians see, hey, I can have my agenda be fulfilled by the central banks, and they have the big bazooka. And so that is part of that instability that I foresee, because they're going to get caught up in things that they don't know what's going to hit them when they come out on the other side of that.
Yeah, I completely agree. I mean, generally, your thoughts on MMT? We're going down that path. It's just this crazy theory. What are your thoughts?
It was a crazy theory, but somehow in recent years, crazy theories have a chance of becoming a reality. Let's keep in mind that Janet Yellen is a labor economist. And so she wants to jumpstart this economy, which means there are different ways of providing economic stimulus. And Trump, for example, he cut taxes for corporations. So when you cut taxes for corporations, that's an indirect stimulus. These companies invest more, they might hire more people, wages may go up, and in the long run, that might be inflationary. Janet Yellen, as a labor economist, wants to be more direct. She wants to have a $400 plus check to the person who's going to spend it. She would be in favor of high infrastructure spending, because those sort of things make it directly to the man and woman on the street. And the key difference from an investor's point of view is that those sort of policies are far more inflationary. People say, oh, after 2008, we didn't have much inflation or anything really, and so it's not going to happen this time. Well, as Larry Summers himself pointed out, we undercompensated after 2008, and now we're overcompensating. Not only are we overcompensating, we are overcompensating with policies that are far more inflationary. And so those things matter, and they will have an impact on asset prices, and particularly, yes, they have an impact on the price of gold, because people always think, oh, gold goes up when inflation goes up. No, gold goes up when the risk of inflation goes up, right? And let me just make kind of one more comment, because you asked about the currency markets. In most countries, when inflation numbers come out higher than expected, you would think the currency goes down. But no, the opposite usually happens. In the immediate aftermath, when inflation is higher than expected, the currency ticks up. And the reason the currency ticks up, because all those smart people in the market say, oh my God, that means the central bank will do the right thing and raise rates, and therefore the return in the currency is going to be higher. It's only then in the coming weeks when people realize, oh, no, they were just kidding, they're not going to do it, that the currency weakens again. And so those dynamics don't happen kind of on a one-on-one basis. And similarly in the price of gold, I mean, the short of it is the markets are there to exert maximum frustration on investors. And they're very good at that, but they're not so good at correlating to the thing that you always think it's going to correlate to.
Yeah, that makes a lot of sense. I mean, what scenario or potential scenario do you see on this path that we've headed down that doesn't end in kind of runaway inflation?
Well, we get inflation such that the Fed or central banks around the world are uncomfortable with it. They start tightening things in earnest, and we'll have a depression type of thing. Then there's an onset of a depression. They said, oh, we didn't mean it, a taper tantrum type of scenario, and they'll try to reflate on an ever more, and we've seen those sort of cycles. They get ever more severe, and we'll be told everything is going to be fine, right? And so it does not have to end in hyperinflation. It creates and can end in all kinds of things. Now, we might get substantial bout of inflation, and we'll be told everything is fine, right? I mean, we have incentives lined up that we have to pay for all this debt that we have, at least as a percentage of GDP, and so we have an incentive to inflate our way out of it. Whether or not it's going to go off the rails, I don't know. Again, as an investor, it's about the risk, right? What is the risk that things will not work as our policymakers have planned? And if one thinks there's that risk, what are you going to do about it, right? And so the one thing I can control is my own health, to limited extent, but I can invest in that at least, and being educated and so forth. And then if I have the flexibility to invest, I can put money into different sort of risk buckets, and I include gold in that, and believe that might take me through that. Now, to just take a step back, when we talk about investing, I think the big question is always, what is one's goal, right? Is the goal to beat the S&P 500? Is the goal to do this and that? And fundamentally, for most people, it is so that one can afford retirement in a way, so that if one's ability to generate cash depreciates, or you're fed up with working, can I retire? One of the things that we have seen, and I talked about that 15 years ago already, society adapts, right? We talked 15 years ago about the baby boomers not having enough money. Well, guess what? They're working longer. And just like women in the 1950s didn't work. Well, if you tell a woman nowadays, hey, why are you working? You're probably going to get slapped in the face, because society now accepts and endorses that women work. Well, society now accepts that 65-year-old works. It's a feature, not a bug, right? And so suddenly we are proud. The fact that it's now necessary to have two breadwinners to earn a living, and that may not be enough, that's a different story. And so don't kind of underestimate the human mind to adapt to the sort of environments. But at the same time, of course, we have a choice, right? Do we want to be the cattle that's going to drag along, or do we want to be hopefully in a situation where if and when inflation does come, that we have the flexibility to decide, rather than having society impose on us what we have to do.
Love it. Very, very well said, and highly, highly relevant. That is a very great little segment that I will share widely with my friends and family, because I think it's very important, right? And we will adapt, and we'll just end up working until we're 95, because that's the new normal, and this will be a distant memory that people once saved for retirement and did something else.
And if I can just do a shout out here to George Schultz, he passed away in early February, and he turned 100 in November last year. And I had last met him on a Zoom meeting the first week of February. He was participating on a weekly basis in at the Hoover Institute in online conferences on monetary policy, and he would every week ask some pointed question. There's a guy who worked well beyond his 90s, active in society, and a great loss to mankind that this great statesman is no longer with us.
Awesome. I before we leave that topic, well, not that topic, but the debt load and increasing rates and kind of having this whipsaw back and forth and everything's fine. I mean, would you see, I mean, obviously you can see, but is it probable of any sort of scenario of extreme austerity playing down the debt as opposed to inflating it out, or even some sort of globally coordinated debt jubilee or cancellation that might happen?
No. Next question. So let me get into that. I have argued ever since I went. By the way, I sold all my stocks in 2007, late 2007, because I said this is going to be bad. I took out physical cash in the late summer of 2008, and was very, very concerned about kind of how this would play out. But austerity is tough, right? What I said at the time is the best, and I still say that today, and if it's a very simple thing, the best short-term policy is a good long-term policy. If people just thought through of what might happen with whatever levels they put in, right? And so instead we're trying to patch up things by bailing people out and whatnot. Austerity means people have to give up entitlements, right? And instead we're doling out more entitlements. And so think of any benefit. The moment you get a pay increase in your job, you take that as a new baseline. The moment you get a medical benefit, the moment you get this or that. And so taking that, and you talked about Brazil earlier. In Brazil, the constitution links Social Security to inflation. It's very difficult to have structural reform and inflate your way out with that. In the US, we have some of that as well. And so that's why people kick the can down the road. And similarly in Europe, right? I mean, austerity was imposed on Greece, and it created a major political challenge. And so over the last 100 years, we have moved further and further away from austerity and embraced credit creation. And so I happen to think we're going to go further and further into that direction, and we haven't seen anything yet. Now, and the reason I said no blanket to both of your questions, if I heard two at least, to the global debt jubilee, it implies so many things that I disagree with. And the reason is that first, it implies global coordination. The Europeans can't even agree on anything in their small area, right? How can the world agree on a reset? It's not going to happen. Everybody is in it for themselves, right? And that's why I say, think much rather, how is society going to adapt? How is this going to evolve? Now, can it lead to war? Yes. Can it lead to a reset? I'm not so sure. Now, maybe that's the ultimate end game, but that's a very, very far down the road. And the other thing it implies that I have a huge problem with, it hands over the control to those smart policymakers that will be enlightened to do a reset. Well, you got to bail yourself out. You can't rely on governments to bail you out. If you want to have a gold standard, have a personal gold standard, but don't think the government is going to do it for you. They're going to tax the hell out of you. They're not going to go back to discipline. And so it has, in my view, the dynamics backwards. It is the individual that has to take the precautions. You can't hope that the government is going to fix things for you. And then the other thing it implies, which I have a huge problem with, is that there is some sort of global coordination of everything that's happening. My own view is actually far more pessimistic. It is that the road to hell is paved with good intentions. I've gotten to know many policymakers over the years. They're good people. They're trying to do the right thing. It's just what they do happens to get us into a worse place more often than not, right? And I mentioned George Shultz for a reason, because he was a principled person who was able to articulate those views in a very reasonable way. We don't have men like him anymore. And And so we have a road to hell that's paved with good intentions. And that also means it's the dynamics of the incentive structure that we have that drive us towards that position. And if one talks about this global reset, it's, oh, there are a few folks that pull the strings and we all just puppets. I don't think that's how the world works. So anyway, that's my rant on that.
No, highly, highly relevant. I'm curious if you were able to wave a magic wand and change one aspect of either incentive structures or some idea within the people making these decisions, what would it be and why?
Well, it would be what I just alluded to. Whenever you make a decision, think about the long-term implications. That rather having the focus on the short term, have the focus on the long term. That's how you build confidence, right? In 2008, we had a problem, right? We kept insolvent institutions alive. And you talked about austerity. Yes, that would have been the right recipe. And so that's obviously the baseline. Now, in practice, that's very difficult, right? I mean, everybody blames all kinds of people for when things go wrong. It's always the prevailing political party that finds kind of the culprit. The other thing, just as a reference point, is we get so gung-ho about which political party is in office. I happen to think that monetary policy is far more relevant than who calls the shots in Washington. That obviously we get excited and concerned and whatnot, depending on where our political preferences are. But what matters much more is what the central banks do than what Obama or Biden or Trump is or has been doing.
Yeah, no, and I think the broader theme and issue of short-termism, short-term thinking, and the ability to stomach the short-term pain that's associated with the right decisions to benefit the long term and benefit the long-term good. It's pervasive throughout every aspect of society at this point.
And there, just to tag on to that, right? The big threat of the current stimulus we have from the Fed is that politicians have gotten a taste that you can spend trillions and nothing happens. Nothing bad happens. Look, asset prices go up, jobs come back, everything is great. And so there is this perception that you can do anything by spending money. And politicians have always had some of that feeling, of course, but it's been exacerbated so much, and we've reached extremes that, in my view, lead us down a road of instability. And by the way, you've heard me talk about instability. That's a code name for some pretty bad stuff.
I just keep saying pitchforks and torches. It should be like a drinking game at this point, because that's the ultimate scenario I see in these situations.
Absolutely. And I mean, if you think back to I talked about that 15 years ago, what happened is we had a global reflationary effort in the time China joined the world stage. We kept America rolling after 9/11, and all of that pushed up energy prices, but kept consumer goods prices lower. Corporate America was squeezed, high input costs, no pricing power, so they accelerated the outsourcing. The man on the street didn't know what was happening to them, except that the purchasing power eroded. That kind of was a big fertile ground for this popular dissent. And so then we elect the populist, and guess what? The populist is not going to make our life better. Then we do a U-turn in the other direction, and things get worse. And that's kind of how that instability is feeding on itself. In the meantime, of course, whoever is in power is blaming lots of people, and we're going to get the pitchforks. Absolutely, yes.
Oh, and something actually that's pretty relevant that I've been thinking about here lately is this is being recorded beginning of February, and Tesla just came out and announced that they had bought $1.5 billion worth of Bitcoin. So Bitcoin is seen as this wealth equalizer, this inflation trade or whatever, and we don't have to go into a lot of detail on it. But the thought was that always it was like the people's money. It was different. It was opting out of the system. But now with MicroStrategy and Tesla and presumably a lot more big tech companies putting this asset on their balance sheet, well, they're publicly traded stocks that are Tesla's in the S&P 500. So everybody that owns the S&P 500 now owns a tiny little bit of Bitcoin through the Tesla balance sheet. So the thought of all of these big corporations putting Bitcoin on their balance sheet, the shareholders that are already the elite few owning the majority of those, that price goes up. If Bitcoin price goes up, the share price of those things go up. It seems like it's almost an accelerator for this wealth inequality that already exists because of the route that it seems to be going down, which is an interesting switch.
So I can't talk about Tesla specifically because I'm not supposed to give investment advice and all that. But let me make some general and broad comments here. When Tesla published this, they actually published it in their 10K, one of the financial reports, and they said they invest in Bitcoin and other. They actually referred to Bitcoin as a digital asset, which I think is the right way to phrase it, and gold. There is also, they said, digital asset and gold. And they'll hold it as an asset because they want to get a higher return on their cash. Now, a few things. Most corporations have an extremely boring cash management, and that is because they're aligning their liabilities and their assets, and so they are not investing in many other things. Now, so whether it's going to get wide traction, it remains to be seen. That said, the underlying motivation, well, one of them might be marketing, of course, that they get some spotlight, but
it's a
main
perfect marketing opportunity, right? If you're this mid-level tech company, like throw it on your balance sheet, announce it.
Obviously, but we also had pet.com, right? In 2000, you add that you're suddenly going to be active in that space, and then your stock price gets a boost. But the broader point is that this concern about the purchasing power of the dollar is, of course, broadening, and this is just a symptom of that. So I'll just leave it at that. Now, more broadly speaking, about the wealth gap increasing because of asset price inflation, I 100% agree with that. I mean, obviously, if you have assets, prices go up. I don't want to suggest that digital assets kind of themselves are the key driver in that. I think that's a much broader trend, and beyond that, it's of course a different discussion about kind of everything that's happening in the digital currency space. The one thing I can tell you, coming from the regulated world, everything I say is censored in some ways, is that regulators love to have control over your money flow because they want to tax it. And so they will find a way, and they already do, of course, in some extent, find a way to getting you back into the system, so that they have kind of a tight grip on you. And the one last comment I want to make maybe on this space is a lot of smart people are working on digital assets, on decentralized ledgers. And I don't know what will be the answer, but we should pay attention to that because there's something going to come out of that that's going to affect our lives in the future. Whether or not it's what Tesla just did, whether that is going to be the prevailing trend, a question is open, but it's certainly a space that's worth watching.
Definitely. Well, I think zooming out, macro, decentralization, these distributed ledgers, they will have a place somewhere in the future. And whether there's a speculative asset like Bitcoin or Ether attached to it is anybody's guess. But yeah, I think especially with a lot of these like deplatforming and things like this, if you have a decentralized social network, well, then you can't censor anything at all, which has its own issues. But there's a lot of benefits that can come from that as well. Awesome. Well, Axel, I've really appreciated this conversation. I think we touched on a lot of very key topics there. And tell you what, I got a lot of really nice little tidbits that I can't wait to pull out and share with my audience. But before we kind of cut this thing off, where can my listeners find out more about you, about Merk Investments? Where do you want to send them?
Well, the easiest place is probably Twitter. At Axel Merk is my handle. That's where I, on a real-time basis, can comment on some of these macro issues. I cannot and will not talk about any products that we do at Merk, but if you go to merkinvestments.com, you can learn everything about we publish research charts on the equity markets and business cycle at merkresearch.com. We have some investment products in the gold and gold mining space and other things, so you can scout around. But go to Twitter, and there you get the interesting bits because you get me commenting on what our lovely policymakers are up to.
Awesome. And Twitter is such a superpower. I had never really used it before a couple of years ago, and the the amount of gold that I get from there is amazing.
Well, to just put in to kind of a pitch for Twitter just briefly, you can curate it in whichever way works for you. Obviously, if you want to follow the folks who post wonderful, cute cat videos, you can do that. But what I do is when I see an interesting article in any publication, I look up who the journalist is and then see whether it's worthwhile to follow that person's Twitter feed. Or similarly, if somebody else tweets something intelligent, and then I once in a while kick out people as well that I follow. But that allows me to create a news flow that is far more valuable than anything you get in the media. I mean, I go to Fox if I want to get the latest on what's happening with the Democrats, and I go to MSNBC if I want to see the latest outrageous things about the Republicans. You kind of know what you get. You actually go to the other side because they post the most exciting stuff that the other side has done, but it's pretty useless for the most part. And so you really got to curate your own news flow. And the important thing is that, especially when it comes to politics, get out of your echo chamber and follow some interesting people or folks who think a little differently from what you do.
Yeah, absolutely. Axel, really appreciate you coming on today. Thank you so much.
Yeah, my pleasure.
There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.